Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Week in Review for the week of September 14th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and pleased to be joined here today once again by Steve Cucchiaro, President and Chief Investment Officer of 3Edge Asset Management. This week, along with an update of the global capital markets, Steve and I will be taking a look at the latest Federal Reserve FOMC meeting, which occurred in the middle of this week. And we'll also take a look at a phenomenon that we have discussed in the past, which we refer to as the Megaphone Market. Before we get to that, though, let's get caught up with the global capital markets and take a look there. And actually, the main news in the global capital markets this week also centered around the Federal Reserve's FOMC meeting and Powell's news conference following the meeting. And even though Chair Powell confirmed that the Fed would remain accommodative for many years to come, investors maybe must have been looking for a little bit more because the market certainly seemed to struggle in the final 3 days of this week. And so actually, let me throw that back to you, Steve. What did you learn from the FOMC meeting this week?
Well, Fritz, I think you're right that, first of all, Chairman Powell used the press conference to give a reminder of all that the Fed had already done. They've already lowered interest rates to zero. They expanded the balance sheet to $7 trillion, meaning literally trillions of dollars of printing money and adding to reserves. And he confirmed that interest rates would stay very low for a very long time. And the prediction of the composite Fed was that interest rates would stay just about 0% until at least the year 2023. So that's what he did. But where the markets might have been disappointed is what he didn't promise. So while he promised to keep rates very low for a very long time, and even if inflation started to pick up, he'd still keep them low. What he didn't promise was that while he was focusing on short-term rates, he didn't promise that he would necessarily buy long-term bonds and keep long-term rates low. He didn't promise that the Fed would do more than what it's already done in terms of further expanding the balance sheet. They're pretty much keeping it at a level that it is right now. And so you could say that the markets are never satisfied. They always want more. They got so much from the Fed in the last few weeks and months, and yet it seems like they even wanted more, and they've already got so much.
Yeah, and I think when we get in this situation, it feels like the market now, they need another catalyst, maybe something else that can drive markets higher, and maybe that's some kind of an agreement in Washington on fiscal stimulus, which doesn't seem like it's forthcoming anytime soon.
I think you're right, and part of the Fed's announcement was an explicit encouragement of the government, of Congress, of the Senate and the House, to get together and come up with some fiscal stimulus, because he pointed out that while the Fed can create lots and lots of reserves with which to lend, it's really the government that has the authority and responsibility to actually spend that money.
Right.
So I think you're absolutely right.
Great, good. So now let's turn our attention to this phenomenon that we referred to in the past. Something that we refer to as a megaphone market. And I believe this is basically where in the current environment where you have extraordinarily low interest rates, that phenomenon may actually increase equity market volatility. And so maybe you could explain that and explain the significance and the implications for investors.
So what we've observed over the last few years is that the market has been tracing an unusual pattern, one that's really not seen except in rare times. And that is when the market is doing well, it makes a new high, and each high is higher than before. But however, when the market takes a downturn, it not only makes a new low, but each low is lower than previously. So higher highs and lower lows. This is a very unusual pattern. If you think about it, it looks like a megaphone. And we can see on the chart, the U.S. stock market is measured by the S&P 500 index, going back just about 3 years. And we can see the higher highs and the lower lows. In January of 2018, we hit a high, and we hit that top line. And then again, we hit that top line in February of 2020. And then we hit it again just at the end of August. So we keep having these sharp rallies and we keep hitting this upward trending line. However, at the same time, we've hit this bottom trending line that's the lower lows. We hit a big low after a major correction in December of 2018. And then, of course, not too long ago in March, we hit a tremendous low in March of 2020. And so the question is, what happens next? And the reason why we want to point out this megaphone market is because it is unusual and it should put everyone on edge. It's a dangerous sign. Everyone loves the higher highs. Stock market investors don't like the idea that we could have another lower low. And so, as you pointed out, Fritz, there is a factor that's not discussed. We don't hear this discussed in the media very much at all, but why we believe we're getting higher highs and lower lows and why this could continue. And it has to do with the fact that interest rates are historically very, very low. In years, all the years of history, worldwide interest rates have never been so low. Why does that have an effect on this megaphone market? Well, if you think about how to value equities, when interest rates are extremely low, that has a very positive factor for equity valuations, and it has, at the same time, simultaneously has a very negative factor. The positive factor is if interest rates are very low, the cost of capital is typically very low. You would value future earning streams with a higher value because you're discounting those future earning streams with a lower cost of capital. So the lower the cost of capital is, the less expensive it is to borrow money and put that money to work. As long as you're making profits, you should pay more and more for that earning stream. And that's been a key driver driving valuations or stock prices up. At the same time, it's a well-known fact, and it's very connected and correlated with history, that when interest rates are very low, it's typically a strong sign that future growth prospects are also very low. And in the valuation formula, expected growth has a big component to calculating what the valuation should be on future stock earnings. So if the prospects of growth are very weak, where we might expect very low growth in the future, then that would hurt valuations. So we have this period where interest rates are so low, you can say they should go to the moon because cost of capital is approaching zero and the earning stream is worth almost infinity. Or you could say, if you have a bearish perspective and there are bad things going on in the world, you could say valuation should really drop because growth is really in trouble. And it's going to be hard to grow the economy and the market when we have so much debt, when we have slow growth because of the COVID. We had slow growth going on even before that because of demographics and so on, and maybe trade wars, et cetera. So this is a dangerous market, and we welcome the opportunity to point this out for our clients and friends.
So this is a very interesting topic for me because it sort of gets to something that I think about a lot in our business, and that is, and we'll use interest rates as an example. So you have very low interest rates now, and that's a phenomenon. And then I always think, okay, does it matter why interest rates are low? Or is just the fact that interest rates are low, that has certain consequences, it affects certain asset classes, et cetera. And so in this instance, it seems like you almost have two factors. These interest rates are either good because you have a low cost of capital, or they're bad because it's telling you that growth prospects aren't so positive. So does that get to this idea of why are interest rates low? Does that matter? Could that help you sort of figure out how to interpret this?
If we could give one helpful message to investors, it would be in a megaphone market like this, with interest rates at extreme, do not be complacent. Do not take the view that all is well forever because low interest rates are only positive factors. There's so many people who just say, look, I'm going to buy stocks, I'm going to hold them forever. The Federal Reserve Board is going to keep interest rates low forever. There's no reason not to own stocks and have all my money in stocks. And I guess what this megaphone market is suggesting is, wait a minute, there is a bullish case to be made. Low interest rates can be very helpful because the cost of capital is so low. However, it has a flip side to it, which is you should be very wary of growth prospects. And this is not just in the US, this is for the world. And there are a lot of factors that could harm growth prospects going forward. And I mentioned some of them. Very high debt to GDP ratios, where there's so much debt that governments and companies have taken on. They're robbing money from the future to pay for the present. Well, where's that money going to be in the future to pay for the future? And that harms growth. Demographics all over the world, aging populations. We're taking people out of the workforce, out of the high consumption producing age groups. And it's not just the developed countries now. There are more recent forecasts saying that worldwide population is going to slow more than people realize, and other factors. So I think this has both sides, and I think a very complacent buy and hold strategy is dangerous here. And I think it's really important to watch to make sure that you've got a pulse on the market, knowing when the slow growth principles are going to start taking more of a hold and when it's time to be more cautious.
Perfect. So remain vigilant, which is what we will do. So that's a great place to end it. That will do it for us. Steve and I will be back again next week with another edition of our 3-Edge Week in Review. Again, if you'd like to submit any questions to us, or if you have a topic for future editions of the 3-Edge Week in Review, you can submit that to us at weekinreview@3edgeam.com. Remember, all of our videos are available on our YouTube channel, which you could feel free to subscribe to. And if you do that, you'll get a notification as we release videos in the future. And always feel free to share these videos with anyone who you think might be interested. So on behalf of Steve and everyone at 3-Edge Asset Management, we urge everyone to remain focused on staying safe and healthy. Steve, thank you again for your valuable insights during this exceptionally uncertain period.
Thank you, Fritz.
And thanks for listening.